Hey, I'm Jordan from Mountway. We've got Trend Talk today, and what I'm talking about is tax debt. Now, in COVID times, not that long ago, the ATO was like your best friend. You could rack up tax debt, they were giving you money at stages, and it was very easy to go through their application process. Accountants in businesses were probably saying that this is the easiest finance you'll ever get, and they weren't wrong. ATO debt was racked up by many small and medium businesses across Australia. And it was done because we wanted to keep businesses open, we wanted to keep them viable, and the ATO was going to be responsible for closing down businesses during COVID. COVID is over. Change of government. The government wants their money and the ATO is chasing it up. And they've been increasingly strident over the last 12 months in recovering tax debt. And with that has come more difficulty to get tax repayment plans approved, more aggressive tax repayment plans than before, and interestingly, some movements around the interest rate they charge, right? So it's not actually as easy finance as you think. The tax department charges you 11.6% interest, which is what an unsecured overdraft with a second tier lender would cost you. So you can get an overdraft, for example, secured with a bank, something like 8.5% interest rate. But when you take that security away and when you start to move into the second tier lenders, you are looking at something like 11.6%. So the ATO is sort of positioning themselves less favourably as a lender for your business. They don't want to be a creditor, they want to get paid when that tax is due each and every time. And they're becoming, as I said, increasingly strident about this, enforcing their position that they are not a creditor, they deserve to be paid. So this is one of the interesting developments. Their interest rate is where it is, and there are some movements to remove the tax deductibility of that interest. All right, so just think about this. If you are a bank lending and via an overdraft funding someone's BAS bill, right? And you use the overdraft to finance that payment, you'll be paying, let's say their equivalent in price, 11.6% with the bank. But you can tax deduct that, right? The company tax rate is 30%. And so therefore you get essentially a 30% discount on that tax once it washes through the after-tax system. So compare that to the ATO. They're taking away tax deductibility on their own interest rates. They're essentially, again, positioning themselves as a more expensive, less favourable lender. They're trying to get away from people using the ATO as a creditor. They're literally 30% more expensive than they used to be. Okay, all good. So the theme is obviously don't use the ATO anymore. They don't want that. And if you do use them, it's going to be more expensive and they're going to be following up that debt. In fact, the way most tax debt arrangements work is once you go into an arrangement, if you miss a lodgement date or if you miss one repayment, the whole plan is null and void, which means technically they could call in that debt straight away. And if you don't pay straight away, they can wind up your business. And literally that is the stakes that are at play. Many times accountants can negotiate different arrangements, but they're really turning the screws to make this high stakes. We're looking at a situation where businesses need to transition with their working capital management to obtaining finance and having lines in place to meet tax debt when it arrives immediately. Make sure it's paid, right? Unfortunately, banks have traditionally been very afraid, suspicious. They just don't like tax debt, right? And so it's very hard to transition suddenly from having the ATO as a creditor and having, let's say, several businesses that I deal with, several $100,000 outstanding with the ATO. You can't transition from that position to having it funded by a bank who doesn't want to do that in the first place, and then going on in future to having the facility there to pay tax anyway. So there's a bit of a crunch point here for businesses across Australia. It's an opportunity for lenders who are prepared to realise that tax debt is just another working capital issue for businesses. Here's a good example. People are very familiar with the concept of insurance premium funding, right? So you get this annual bill for insurance. It's usually a pretty high bill. You've got to have it. and so you pay it. But rather than having that one bill hit you in 1 month, and it may not even be a good month, it might be one of your low months throughout the year, there's an availability of insurance premium funding where that bill is spread out for 10 months with a little bit of interest added on top, right? So that's accepted. But somehow we haven't had banks willing to accept and finance the reality of tax, which comes once a quarter or once per annum, in the case of income tax, which equally has a working capital impact if you have to meet that big lump sum bill in a particular month. So we're in interesting times. I think there will be astute lenders out there, probably not our banks, but second tier and third tier lenders who see this as an opportunity to refinance tax debt and to get businesses onto an arrangement where they can meet their tax obligations as they come up at something like 11.6%, which is comparable to the ATO. Okay guys, until next time, I'll see you in the next Trend Talk.